everybody. Welcome to the podcast. It's the 1st of May, and the month has started off on the wrong foot if you own a bunch of stocks, and it started off on the right foot if you're short the market. So those that say sell in May and go away seem to have the upper hand, at least for one day. But as I said in yesterday's podcast, please don't let that be your strategy. Yes, it fits in very nicely. We've had a first quarter run, and it would make a lot of sense for the stock market to cut some of those gains, have some profits taken, and the stock market to go down in May. If it happens, I think it'll be coincidental. I do not think just because we flip the calendar, which I guess nowadays we don't flip the calendar, it just kind of changes automatically based on our computers, our notebooks, our iPhones, our Android phones. We have to include Android phones now. We can't just talk about iPhones because they're not quite as dominant anymore, right? But all those electronic devices change the calendar for us. So the point is, no more flipping of the calendar. But with that said, it is May, so sell in May and go away, I guess, was the mantra of the day. But bottom line is, we talked about it in last night's podcast that we were starting to see some warning signs, very subtle. I didn't necessarily think today would be the day the stock market started to go down, but oftentimes when you do flip the calendar, not necessarily for March or April or May or June, but just simply go into a new month or a new quarter, things tend to move opposite that first couple of days. You know, if the market's gone down a lot, people start to step in, and then if it's been going up a lot, people want to take profits for whatever reason when the calendar changes. But the Dow Jones was down 140 points today, almost 1%. The NASDAQ was down almost 1%, about 30 points. It fell below 3,300. The Dow Jones is sitting at 14,700. The S&P 500 is at 1582, down almost 1%. The Russell 2000, which I told you in last night's podcast, we took profits in our small caps and sold those yesterday because they had been, the last few days they had been leading, but in the last few sessions, couple of weeks, they had been kind of lagging. And in fact, if you take a look at the Russell, we talked about this, that while everything else was celebrating new highs, the Russell was not, and kind of had been working its way down here. And so it was running into a lot of technical speak resistance kind of at these higher levels. So it's got to kind of hang on to, I think, this 100-day moving average, which is this purple line here. And but 2.5%, really severely underperformed the rest of the market. So good thing we did take profits yesterday on that. And some of you ask me a lot of times, how do we know what's going to happen? Obviously, we don't know what's going to happen, but what we try to do is stay very agnostic, and that means not leaning too far bullish or too far bearish. And we do a couple of things. Number one, we look at the internals of the market. For example, today you come home from work, you see that the Dow Jones is down 140 points, and you automatically assume that it was a really awful day. When we look at the internals, what we see when we examine everything and we strip out some of these REITs and closed-end funds and things that trade on the exchanges, we strip those out and just look at the plain old operating companies, the companies like Disney, Coca-Cola, and small companies, and all those actual widget-making companies. What we see is that today was more a function of really what we've seen the last few weeks when the market has sold off a little bit, which was really just buyers taking a break. There wasn't as much demand for stocks, but there wasn't this intense selling that you would associate with a 140-point decline. So that's one thing we do, is look at the internals of the market, and I use that term a lot because it's not just one indicator. Again, I want to stress that for those that use MACD or Bollinger Bands or volume or whatever it might be, you got to look at all those things in culmination, and especially they don't always apply to every stock or every index. So you need to use different indicators for different indices you watch. So I use a lot of different things, but that whole culmination of it, when you really examine the market and you look at the volume and the down volume and the up volume and how many stocks are going up versus down, and you strip out those things we talked about and just have the operating companies, it gives you a clearer picture. And a lot of that sometimes we can't see until very close to the close or even after the close. Some of the data comes in, we analyze it. But I'm still not seeing this overwhelming supply of stocks where people are really saying, get me out at all cost. It's more of a pause. And now, regardless, a pause can take you down just like it took us down in September to the mid-November right after the election. It can take you down 10, 15%. And those types of corrections can happen at any moment. So while I don't think this is the beginning of a bear market, I do think it is a time to take some profits. And I talked about that yesterday. We actually went in at the open this morning and took profits on a couple of more things. Unfortunately, did that because the stock market continued to fall the entire day. In fact, if we take a look at the S&P 500 and we take a look at this on a 1 minute basis today, you can see that it sold off at the beginning just a little bit, and then it just drifted lower all day long and pretty much finished at its low of the day. So, when you see the futures down and you're wanting to sell, don't necessarily hesitate selling. We sold a lot of things right at the opening tick, and the stock market continued to sell off. So by doing that, it saved us a good 1% or so on some of those positions. And some of those things that we had been talking about that we had been in the last few months, things like healthcare, took profits on those. And so there's some of those items that we just simply locked in gains and moved in some safer areas. Those areas involve cash, some bonds and things like that. Again, for a temporary move. This still, to me, looks like it's going to be a temporary sell-off, but we don't know, right? We don't have the crystal ball. So all we have to do is examine the market for what it is right now. And I mentioned one way by looking at the internals. The other way, the other thing that we do that helps us a lot is by looking at a bunch of different industries, bunch of different sectors, and analyzing them on a relative basis to each other. So what that means is we want to see which ones are exhibiting the most strength, which ones are the least volatile, showing the most strength compared to the other ones. And that really helps us to see where the money is flowing. Where are the institutions exiting out of, and where are they shifting to? And obviously, they've been shifting away from things like gold and emerging markets and materials. And in the last few months, they've been shifting towards consumer staples. They've been shifting towards healthcare, telecom. They've been shifting towards REITs. They've been shifting towards utilities. And a lot of people believe that's the problem with this market. And as I said in last night's podcast, just own them and don't fight that. But what we've seen in the last few days is more of a shift into treasuries and corporate bonds and starting to take profits in those things like healthcare. Small caps financials are starting to kind of work their way down the list, so to speak. And so simply we are following that money. And so, again, when you're putting a portfolio together, we think it's important to not only focus on where the money's flowing. That's one part of the portfolio. But again, focusing on income and that stability part. And then if you want to take a stab at some of those things that are very out of favor, things like gold or emerging markets, that's fine as long as it's in moderation. If you think you're just a value picker, meaning kind of a Warren Buffett type, except without a bunch of zeros on the end of your portfolio like his, he has patience. He can go to companies and negotiate special deals. You can't. I can't. So what we have to do is buy a value when we see it, but we can't load the portfolio in that, because when we do that, we could be wrong, right? A lot of people in 1995, right when that real strong bull market was starting for the late 90s, was in 1995. In 94, people were buying a lot of value stocks, things that were reasonably priced, and then the 90s came, and what worked? High PE ratio stocks, right? Cisco Systems, Microsoft, Intel, all this tech stuff that fundamentally didn't make a lot of sense. Now you could argue, yeah, but we were entering the internet age, and so it did make sense. Fine, but when you looked at it from a pure cash flow perspective, earnings perspective, return on equity, return on capital, where their cash flow was coming from, it didn't make a whole bunch of sense. But if you didn't buy those things, you missed out on one heck of a rally in the 90s. So again, you have to adapt. And because we can't always adapt and take all of our portfolio and focus on what's working, then we have to balance it out. But I think if you're simply sitting there trying to buy the value stuff or be a contrarian all the time, you're going to miss out on the things that are working. And so for those that have been not in places like utilities, which, if you take a look at utilities here, they've been fantastic. They've been going straight up. Now, were they down today? Sure they were. But they've had a few down days along the way. So it's not that they're not going to be down, but what we're looking for is the trend. And the trend has been up, and it would have been hard for you to buy it here and here and here and here. But it's still working. Money is still flowing in there. Could today be the top? Sure, but I want to see that happen first. I want to see the trend change before it changes my mind, and I want to monitor how that sector is doing versus all the other sectors on a relative basis. And once I see that it's not holding its or pulling its weight, so to speak, that's when I will exit it. And that means ignoring some of the daily noise and even some of the weekly noise. And but right now, utilities have still been doing very well. Staples have been doing very well. REITs have been doing very well. If you take a look at things like Staples, again, they barely were down on the day. They were fractionally lower, about 10 basis points. So they held up very well, even though they did close pretty much on the low of the day. And I think at one point today they were actually up. You can see that little, as they call it, a hairy top here. We won't talk about the opposite of a hairy top. But anyways, because this is a family show, this is a family podcast. That's what we do. We keep things clean. But if you take a look at, REITs, for example, again, up near their highs. And we're down on the day, but these things have been very strong. On the flip side, when we look at things like emerging markets, they've shown some strength lately, and maybe they are bottoming. Maybe people will rotate out of American emerging markets. But until proven otherwise, they're still the weakest of the bunch. And when you look at, gold, again, had a down day today, although it did cut its losses probably in half. But again, they've been weak. And so where's this money flowing? And that's why it's so important to zoom out, take the 30,000-foot view, and analyze the entire market and the landscape, and then shift the portfolio accordingly. Easier said than done, but again, that's why I point out you have to have systems in place. And again, these are the systems that caused me to start scaling back a little bit in the last few days. And it was a fortunate move and a good move. And again, today's only one day, but what we tend to see is trends that tend to stay there for a while. For example, when you look at gold had been falling, and there were so many times you would say, well, surely it's bottomed, right? And you go back, and it kept falling. Finally, it just vomited on itself, for lack of a better term, and it still went down. How about Apple? That's a classic example of a stock that was going down, and every time it started to rally, there was people calling for generational lows. And yes, it felt like a good deal here, felt like a good deal here, and here, and here, and here, and here, and maybe it was here finally. But here's the thing. Trends that keep going tend to keep going for a while. That's why Apple was doing what it was doing. Meanwhile, utilities and healthcare and things like that, where people were saying, hey, they're overbought, they continue. It just happens that way. And so part of our job is to focus on that and buy those things. And that's really a big lesson for today, because there's the old adage on Wall Street, do not trim the flowers to water the weeds. What that means is 2 months ago, had you sold your utilities here because they had gone up and you had, quote, made enough, and it looked like a double top, right? Right here, compared to here, it was a double top. It had to go down, and it didn't. It kept going up. But had you sold your utilities and then went in at the same time and bought, let's say, Apple here, you would have lost a good chunk of money for that trade. And so don't always be the contrarian. Now, again, for those people who are on the other side of the ledger and are all momentum-based and only focusing where the money's flowing, they will at some point get burned as well. And that's why you need this balanced approach of buying value things, buying contrarian plays, but just don't load the boat in one specific strategy, because you're setting yourself up for failure, I believe. All right, guys, let's see if this continues for a while. I think the healthiest thing for the market on the upside would be a more violent, sharp sell-off, kind of like we had a couple of weeks ago. The volume picks up a little bit, and if that happens and that fear picks up, which if we look at fear, the VIX was up 7% today, not a huge day when you look at some of the bigger days we've had in the past. But if we get this spike in fear, that's what leads to bottoms. And again, this market is still in an uptrend. So even though I've been taking profits, that does not mean, shifting to more conservative investments in the short term, that does not mean that I would go out and short the market at this point and get ultra bearish. I want to be very clear there. I just think let's scale it back a little bit. If we're talking about a 0 to 10 scale and 10 being the riskiest, let's shift it down to maybe 5. That's what I'm doing, as opposed to 9 or 10, 3 days ago. And then obviously if the market does fall and we see a real nice entry point, then you can shift it up a little bit. But this is not a time to be at 0 on that risk scale. At least I don't think so, because while this could be the start of something, I don't see much evidence right now. The Fed told us today in one of the funniest statements of the day, we either will continue buying bonds or we won't, right? We'll increase our purchasing or we will decrease it. Thanks for that. That gives us a lot of help. But look, we already knew that. So that's why it's not a really market moving statement. We know what they're going to do. The economy is showing enough weakness right now in the short term, whether it's a soft patch or not. The data that's been coming out is getting weaker in the last couple of weeks. If that continues, they're going to keep printing dollars. They're going to keep buying bonds and until further notice. And that means the stock market may have a floor underneath it at some level, but that does not mean it can't go through some corrections. So that's your update for the day. Thank you very much. Don't forget to keep the questions coming, and we'll answer them on a podcast. Sometimes I just answer them back in an email. Sometimes I do them on a podcast if I think everybody will benefit from the question. But don't hesitate to ask those questions, because they're not dumb. They're actually probably questions that most people have that are watching this. So thank you for joining me. Appreciate it, and have a wonderful day as usual.